Hey everyone, welcome back to the channel, your go-to place for real-world money talk. Today we're diving into one of the most crucial questions of 2025. Will the Federal Reserve finally cut interest rates this year? And more importantly, what does that mean for your money? If you've got a mortgage, credit card debt, savings account, or you're investing in the stock market, this video is for you. Make sure to hit that like button, subscribe, and let's break it down. Let's rewind a bit. From 2022 to 2023, the Federal Reserve hiked interest rates aggressively to combat inflation, which had skyrocketed post-COVID, and due to global supply chain issues and energy prices. By mid-2023, the Fed funds rate reached a range of 5.25% to 5.50%, the highest it had been in over 22 years. That made borrowing money a lot more expensive, whether it was for a home, car, business loan, or credit card balance. Fast forward to 2024, inflation cooled down from over 9% in 2022 to around 3%, but not quite at the Fed's target of 2%. So the Fed decided to hold rates steady, but didn't cut them, yet. So why is everyone talking about rate cuts in 2025? There are three major reasons. Inflation is slowing, core inflation is coming down, and supply chains have mostly stabilized. Growth is cooling, GDP growth is slowing, job creation has softened, and consumer spending is showing signs of fatigue. It's an election year. Yes, politics plays a role. Historically, the Fed tries to avoid big surprises during an election cycle, but pressure is building to support the economy without causing more pain. Fed Chair Jerome Powell recently said the Fed is being data dependent, meaning any rate cut depends on upcoming inflation and employment numbers. Okay, so what if the Fed does cut rates? Here's what it means for you. Mortgage rates drop. Buying a home? Expect mortgage rates to drop from 7% to possibly 5 to 6%, making monthly payments more affordable. Credit card and loan rates ease. Carrying debt? Lower rates mean lower interest on revolving credit, auto loans, and personal loans. Stock market could rally. Historically, rate cuts are great for equities, growth stocks in particular, as borrowing costs fall and corporate profits rise. Savings account returns go down. On the flip side, those 4 to 5% returns on high-yield savings accounts, expect those to shrink as banks cut their own rates. Real estate heats up again. With borrowing costs dropping, we may see more activity in real estate markets, pushing prices higher again. So yeah, the ripple effect is huge. Now the golden question: how should you prepare for potential rate cuts? 1. Refinance high-interest debt. If you've got a mortgage or a personal loan at a high fixed rate, stay alert. Refinancing might become a smart move again. 2. Adjust your investment strategy. Lower rates usually favor growth stocks and tech companies. It could be a great time to rebalance your portfolio if you're too heavy on bonds or value stocks. 3. Lock in savings yields. Got extra cash in a high-yield savings account or a CD? Consider locking in a longer-term CD to preserve that high yield before rates fall. 4. Rethink big purchases. Planning to buy a car or house? If rates drop, waiting a few months might save you thousands in interest. 5. Watch the Fed calendar. Stay tuned to key events, CPI data, Fed meeting minutes, and employment reports. Those will give you hints about when rate cuts may actually start. Basically, stay flexible and ready to pivot. So, will the Fed cut interest rates in 2025? Probably, but only if the data supports it. As always, you want to be proactive, not reactive with your money. Keep your eye on inflation, job market trends, and of course, Fed statements. What's your plan if rates start dropping? Will you refinance? Invest more? Let me know in the comments below. If you found this helpful, give it a thumbs up, subscribe to the channel, and turn on notifications so you never miss a beat on money, markets, and smart financial moves. Thanks for watching, and I'll catch you in the next one.